Imagine sitting on a pile of money inside your own house and not even knowing it. That's the hidden power of a home equity loan. But here's the twist. Many homeowners never use it correctly. Some don't even realize they qualify. Others think it's too complicated. By the end of this video, you'll know exactly how to get a home equity loan, step by step, without feeling overwhelmed. And I'll reveal a mistake that can cost you thousands if you are not careful. So stay with me. Number 1. What a home equity loan really is. Think of your house like a treasure chest. Every payment you make chips away at your mortgage and adds more treasure inside. That treasure is equity. Equity is simply the difference between what your home is worth today and what you still owe on your mortgage. For example, if your home is valued at $300,000 and you owe $200,000, you have $100,000 in equity. A home equity loan lets you borrow against that value. It's like telling the bank, I already own part of this home, so let me borrow money against my ownership. Number 2. How much you can borrow. Most lenders will let you borrow up to 80 or sometimes 85% of your home's value, minus what you still owe on your mortgage. Let's use an example. Your home is worth $300,000. At 80%, the maximum loanable amount is $240,000. If you owe $200,000 on your mortgage, then $240,000 minus $200,000 equals to $40,000. That's how much you may be able to borrow with a home equity loan. But not every lender has the same rule. Some are stricter, some more flexible. This is why shopping around is key. Number 3. Who qualifies for a home equity loan? Lenders don't just look at your home. They look at you. They usually want you to have at least 15 to 20% equity built in your home. They check your credit score. A score above 620 makes life easier, but a higher score gets you a better interest rate. They also review your income and debt-to-income ratio. Most lenders like to see your total monthly debts take up less than 43% of your monthly income. Example, if you earn $5,000 a month, lenders usually want your total debts, including your new home equity loan payment, to stay under $2,150. Number 4. What you need before applying. Before you run to the bank, gather your documents. You'll typically need proof of income like pay stubs or tax returns. You'll need your mortgage statement to show what you still owe. And you'll need your home's current value. Some lenders order an appraisal to verify how much your house is worth today. Example, imagine you think your house is worth $250,000, but the appraisal comes in at $230,000. That smaller number changes how much you can borrow. Number 5. The application process step by step. First, research different lenders. Don't just walk into your current bank. Online lenders, credit unions, and mortgage companies may all have different offers. Second, submit an application. You'll answer questions about your home, income, and debts. Third, the lender reviews your paperwork and may order an appraisal. Fourth, if approved, you sign the loan documents at closing. After that, you typically have a 3-day waiting period before you receive the money. It's like applying for your first job. You show your qualifications, wait for approval, and finally start working. Only this time, the job is giving you a big check. Number 6. Fixed rate advantage. A home equity loan usually comes with a fixed interest rate. This means your monthly payments stay the same for the life of the loan. Example, if you borrow $30,000 with a 6% fixed rate for 15 years, your monthly payment will not change. That stability makes budgeting much easier. Compare this to a credit card with rates that jump around, and you'll see why people prefer home equity loans for big expenses. Number 7. Smart uses for a home equity loan. Used wisely, a home equity loan can be a powerful tool. Many people use it to renovate their home. For example, borrowing $25,000 to remodel a kitchen could increase the value of the home by even more. Others use it to consolidate debt. Imagine you have $15,000 in credit card debt at 20% interest. A home equity loan at 7% saves you thousands in interest over time. Some families use it for education expenses or emergency medical bills. But here's the golden rule. Use it for something that builds your wealth or protects your family, not for a shopping spree or a vacation. Number 8. The big risks you must know. Here's the part most people skip, and it's the reason you must stay alert. A home equity loan is secured by your house. That means if you don't pay, the lender can foreclose and take your home. This isn't like missing a credit card payment where you get calls and late fees. Here, your roof is on the line. Also, borrowing too much can trap you. Imagine using all your equity and then your home's value drops. You could end up owing more than your house is worth. That's called being underwater, and it's not a fun place to be. Number 9. Costs you might overlook. Home equity loans aren't free. You may face closing costs, often between 2 to 5% of the loan amount. If you borrow $40,000, closing costs could be $800 to $2,000. Some lenders also charge appraisal fees, document fees, and even an annual fee. Always ask for a loan estimate before agreeing. That document shows you the true cost. Number 10. Home equity loan versus HELOC. A common point of confusion is the difference between a home equity loan and a HELOC, which stands for Home Equity Line of Credit. A home equity loan gives you one lump sum with fixed payments. A HELOC works like a credit card. You can borrow, repay, and borrow again up to a certain limit. But HELOC rates are usually variable, meaning your payments can change. Example: if you know you need exactly $20,000 for a roof repair, a home equity loan is perfect. But if you have ongoing expenses, like paying tuition each year, a HELOC might give you more flexibility. Number 11. The hidden mistake that costs thousands. Here's the curiosity loop I mentioned earlier. The biggest mistake homeowners make with home equity loans is not comparing lenders. Many people walk into their current bank and accept the first offer. But a small difference in interest rate makes a huge difference. Example: borrowing $40,000 at 7% for 15 years costs around $12,500 in interest. At 8%, it costs about $14,500. That's a $2,000 difference just by choosing the wrong lender. Never accept the first offer. Compare at least 3. Number 12. Steps to take right now. Step 1. Check your home's current value. Websites like Zillow give estimates, but an appraisal gives the real number. Step 2. Look at your mortgage balance. Subtract that from your home's value to see your equity. Step 3. Pull your credit report for free. Fix any errors before applying. Step 4. Compare lenders, interest rates, and closing costs. These steps put you in control before you even apply. Number 13. How long you have to repay. Home equity loans are not short-term. Most repayment periods range from 5 years up to 30 years. The most common terms are 10, 15, or 20 years. For example, if you borrow $30,000, you could choose a 10-year loan with higher monthly payments but less total interest, or a 20-year loan with lower monthly payments but more interest over time. It's like choosing between running a sprint or pacing yourself in a marathon. Number 14. Tax benefits you might get. Interest paid on a home equity loan may be tax deductible, but only if the loan is used to buy, build, or substantially improve your home. For example, if you borrow $25,000 to remodel your kitchen, you may qualify for a deduction. But if you use that money to pay off credit cards or go on vacation, the deduction won't apply. This is a detail many homeowners overlook and miss out on savings during tax season. Number 15. How fast you can get the money. One question beginners always ask is, how long until I actually get the cash? The answer depends on the lender. After approval, there's a mandatory 3-day waiting period called the right of rescission. After that, the funds are usually deposited within a week. So from application to cash in hand, expect anywhere from 2 to 6 weeks. If you need money tomorrow, a home equity loan won't work. Number 16. When a home equity loan makes no sense. Sometimes, the smartest move is not taking the loan at all. If you plan to sell your house soon, it may not be worth adding new debt. If your job or income is unstable, the risk of missing payments could be too high. Or if your equity is still very low, the closing costs alone might eat up any benefit. Example: borrowing $10,000 with $2,000 in closing costs means you lose 20% of the loan right away. Number 17. How your credit score is impacted. Taking a home equity loan affects your credit. The lender will run a hard inquiry on your credit report, which may drop your score slightly in the short term. But making on time payments every month can improve your credit over time. On the flip side, missing payments can destroy your score and put your home at risk. Think of it as a double-edged sword. Handle it carefully, and it helps you. Mishandle it, and it cuts back. Number 18. Alternatives to a home equity loan. If you're not ready to use your home as collateral, there are other options. A personal loan is unsecured, meaning your house isn't at risk, but the interest rate is usually higher. A cash-out refinance replaces your current mortgage with a new one for a larger amount and gives you the difference in cash. Example: if your current mortgage is $150,000 and you refinance into a $180,000 mortgage, you walk away with $30,000 in cash. Each option has pros and cons depending on your situation. Number 19. What happens if you sell your home? If you take a home equity loan and then sell your house, the loan must be paid off at closing. For example, if you sell your house for $300,000 but still owe $200,000 on your mortgage and $30,000 on a home equity loan, $230,000 goes to pay off both loans, and you pocket the rest. This is why planning ahead is so important. Number 20. The psychological side of borrowing. A home equity loan feels different from swiping a credit card. It's bigger. It's tied to your house. And for many people, that creates a false sense of easy money. But it's not free. When you borrow against your home, you're trading future stability for cash today. Keeping that mindset helps you avoid using the money for things you'll regret later. Owning a home is like sitting on hidden treasure in a home. Equity loan is the key to unlock it. Used wisely, it can pay for education, erase high-interest debt, or add value through renovations. Used recklessly, it can put your home at risk. So here's my question for you. If you were approved for a home equity loan today, would you use it to pay off debt, renovate your home, or invest in something new?